Economics is estimating that core inflation could be the slowest since 2021. In theory, that's a good thing. Let's see if it is in practice. Bloomberg's Valerie Titel joins us. Valerie, walk us through the trade that we could see play out today.
It's expected to get a quite a soft number today, and I think the smart consensus out there is even going for a softer number than what we see on the Bloomberg consensus screen. But it has been an uncomfortably gradual easing in inflation. We really need to start seeing a 0.2 month on month or a 0.1 month on month in order for the Fed to feel a bit more comfortable here. Now, I want to take a look at what's been going on in the VIX market. I think something is really interesting I wanted to point out. The one-day VIX going into this is pricing the lowest one-day vol over the entire cycle. And that's because economists have been rather accurate in predicting inflation in 2023, and it has continued to fall. So perhaps we could get some equity market jump on a soft print, but it's unlikely to be the kind of volatile days that we've had, especially when you look at one of the biggest volatile days of last year all around these CPI prints. And that's just because it's really unlikely to shift the Fed hiking narrative for July. Markets are really expecting another 25 basis point rate rise from the Fed in just 2 weeks' time. But we do hear from 3 Fed speakers after the number today. We hear from Kashkari, we hear from Bostic, and we hear from Mester. Now, if we get another cool non-housing core CPI print, it goes a long way from strengthening arguments like to some officials like Bostic that say the Fed can afford to be patient, let the long and variable lags take hold, and let that push inflation lower itself. So keep an eye if we do get any shift in language from these Fed speakers after the CPI print this afternoon.
These yield levels, we're at the top of the range, and it's difficult really to imagine yields making a break above 4% on a sustained basis. So I think that the top for yields is in. The easy part of the inflation decline is done. We know it's going to be choppy from here, but it's a very, very, each meeting is live. They might hike, they might not. We're much closer to the end of the tightening cycle, and therefore, if you've got a horizon of 3 to 6 months, you're thinking, well, if most of it's done, then I'm fairly safe to start investing. And that's what's slowly happening in fixed income, I think.
So that's what's happening slowly. So you're talking about 4%. So you're talking about obviously about the 10-year there, and you say the ceiling is in. That's the top. What do you make of? In recent sessions, we've talked a little bit about how yes, we've had inverted curves for a long time now, and we've quite recently seen quite a lot of steepening in some parts, as if, and sometimes that's a signal, isn't it?
Totally.
About recessions, when we've had a period of inversion and then we re-steepen. What do you make of those kind of signals?
Just on the first point, Anna, I think I've called the top on yields countless times in the last year, but it hasn't actually been wrong because the peak was in last October, and we've gone down in yield in 4 months and up in yield for the other 4, which happened to be actually the last 2 months yields went up. So in fact we're flat right now in fixed income terms. That's what you want. If I could tell you today that you're safe to invest and that you're not going to lose a great deal of money, but you might make a lot, that looks like a good risk reward, right? Because if you're still at 4% at year end, you've had the coupon. Right, so in this case, you had half the coupon, you had 2%. But you might make a lot if the yields head down towards 3. It's unlikely you're going to go to 4.5 or 5. So it's a risk reward.
But how fast? How fast is the?
Well, I think in terms of speed, the big move is much later in the year. So it's the last quarter, not the third quarter when this is going to happen.
We could end the year at 3.
Well, that's our forecast.
We're obviously well awaiting central bank policy responses from around the world, getting the RBNZ just now, policy rhetoric from the RBA. Now I just think we're in tune with a gentle but forceful forecasting of how we're going to adapt to a higher inflationary regime here, and more importantly, how central banks are going to continue to adapt to it, being more data dependent perhaps, being more pensive and elaborate a longer adoption process. But it doesn't necessarily always mean that you're going to get a higher rate hiking cycle, and it probably means that we have to not necessarily handicap the traditional reaction of weaker growth, which is accompanied by lower rates and a more stimulative process. So we have a balance of tasks here ahead of us over the next few quarters, which are going to be confounding, just as you just mentioned, with the RBA. So the task is at hand for investors and portfolio managers alike over the next few quarters.
Yeah, it seems that the pandemic has just messed with our ability to analyze cycles in many ways. So you have data that's soft. You have labor data in the U.S., for example, that's quite strong. What do you think the assumption? What are we assuming that's wrong?
Well, I think one of the practicalities is that we're getting back to an economy, perhaps, and maybe central bank policies, which are reflective of a non-stimulative era. We are getting back to a pre-global financial crisis